Hello everybody, it's Bob Anderson, and the last part I want to put into this training section is just some general topic stuff. And first off, I'd like to say in this general topic stuff that having put the prior videos together, I realized, man, okay, maybe this isn't the simplest thing in the world. You know, it's not the simplest strategy per se, but I have people that are all over, and I mean literally all over the world, who have watched my videos, used these techniques, and have emailed me. And one of the things that I found as one of the relative common threads in at least half the people that have messaged me about, you know, it working and they're excited and they like it and all that stuff, was the simplicity of it. So maybe it just seems overwhelming to me because I have sat down and put these videos together in such a crash course way, and I didn't really do it over a long period of time. I just, I was like, trying to throw these things together. So maybe it just seems overwhelming to me. I know when I'm actually trading and because I recognize these patterns so well, I feel almost like I know in advance what's about to happen. And I can tell you this. That is the bliss that I get now from learning these 3 trading strategies: the static line, 5-minute red line, and the 1-minute gold line. And so the last thing I want to talk is just some general things, but I didn't even write one thing down. And that is the best thing that I have ever done, even when knowing this trading strategy, was to learn not to overtrade. When you start seeing the trades that are, those real high probability winners, because you've seen the actual pattern, you've seen the actual layout, you've seen it before at this time of day, that kind of stuff. I mean, bam. And that's when you pounce. That's when you make your money. And what you don't want to be doing is making up for all the money you lost while you were guessing, well, this might work. And, oh, well, this might work. I'm just telling you, because even after knowing this strategy, what made me profitable overall was to be disciplined enough to not take the trades that I think are going to do this because of these things. Instead, I took the trades that I really felt like, hey, this is going to do that. Just like today. Today, I took 2 trades. First one went up. I put myself at break even, came back down, knocked me out. Second one, I got in, wham, 2 minutes, 40 ticks in gold, wham. That was it. Okay? And that's where you've got to get yourself to. So 2 trades. The day before, I think I took 3 trades total. I mean, it's not about the quantity of trades, it's about the quality of trades. So let's talk about some of the things that help you determine the quality of trades, okay? One of them is correlation of direction of the equity market. So one of the things, for example, with the RTY and the NQ. Now, I have talked ad nauseum to you guys about how I like the RTY because it moves in straight lines, and it does. When it's moving north and south, it moves in straight lines. But one of the things I've noticed over time is that, for example, if I'm looking at a possible long in the RTY, it really helps if I'm looking over at the NQ at the same time and it is in the long position and it doesn't have headwinds above it. So what does that mean? So for example, that means that the RTY is getting ready for a long. So let's just say that long is a 1 minute gold line. Let's just say. And so that means, it's north of the 5 minute red line. It has, so it's creating a Donchian high before a pullback, all that kind of stuff. And if I look over at the NQ, and the NQ is about ready to run into the bottom of the red line, yeah, I'm probably going to have a problem. But if the NQ is just hanging out in bliss, north of the 5 minute red line, and it's not about to run into the bottom of an overnight open or the bottom of a prior day close, something that we would expect it to kind of get into a battle. If the NQ is over here just kind of hanging out in bliss in a long position, and it's not about to run into things, then the probability that this trade is going to work has gone up another 15-20% in my mind. Okay, because again, it's not about quantity, it's about quality. And so one of the things I like to do now is I have them sitting side by side and I look at them. You can even split your screen. I've showed it a few times in my videos where I've split the screen and put them both on the same screen if you got screen space limitations. And then and then when one of them is setting up a trade, you just blow that one up. I mean, you've looked at the other one, see that it agrees, and then you blow the one up that you're going to take the trade off of and go from there. Even if you've got just one screen, you can check for correlation of those equity markets. Okay, so the next one is volume creates that north and south movement, and if you remember, I talk about you gotta stretch the rubber band to get that reaction back in the direction of the trade you just took. You got to stretch that rubber band. Well, you can't stretch a rubber band if price is just doing this. And here's a key thing to remember. Price does this, guess what happens? The moving average will migrate to price. So if the moving average migrates to price, it's not a good trade. If price migrates to the moving average, it's a better trade. So that's what you want. You want price to move to the moving average. Just, I'm assuming most of you understand this, but, as price keeps doing this, the moving averages are going to consolidate to that price because it's an average of so many of the candles, to the left. That's what the moving averages are tied to. So if that moving average is what migrates to price, you got a problem. That's not a tradable event. A tradable event is when moving average is kind of hanging out here and price decides to go to it. That's your trade. Volume, and that's when there'll be a spike of volume, but I don't use a volume indicator or anything because I'm looking for candles. I'm looking for candles that have decision and direction and authority to them. Okay? That's how in that way you don't have to have another indicator on your chart and some crazy, and then, some kind of craziness that just creates opportunities to put you into bad trades or to confuse you with all more exceptions of when, if the volume really is doing this instead of that and crap. Forget it. Read the candles. And then use those moving averages and static lines as your pivot points to get you that entry away from that spot. Okay? No news trading. This trading strategy is not something you do during news, okay? It's period. And that means leading up to news and post news. Now, post news, it's like you just got to kind of see the candles are starting to get a little more rhythmic again, and then you can start looking. I don't really use a time because it's a feel. You just got to kind of look, and you'll get that when you just do this for a while. Next is risk reward. Now, let me tell you something. You must have ATMs when you trade this. Don't take blind naked trades. You got to have an ATM, and I have I have 4 ATMs on my charts. I have one for gold, I have one for NQ, I have one for RTY, and I have one for oil. I'm probably going to be putting the ES back on my charts, just as a side note, not that it really matters, because oil has just been dead for so long. So I'm probably going to put the ES back on my chart. But anyways, risk reward. I don't have any of my ATMs. All my ATMs are set up minimum right now for a for minimum 2 to 1. So and that's just to put something on the chart. So for example, with gold, it'll pop on my chart with a 40 tick target and a 20 tick stop. That's how my lines drop on it. But then I grab my stop and I put it where it needs to be. If it needs to be closer to break even, that's what I do. And then I wait for price to kind of start running off, and then I'm very aggressive, especially on the NQ. Especially on the NQ. I'm very aggressive about getting my stop to break even. Okay? But it depends on the trade type too. You know, the red line, you gotta let it work its way. So you need to stay with pivots and that kind of stuff. But you've got to enter these trades with the mentality that you're trying to make minimum double what you were willing to risk out of the gate. I cannot stress that enough. How many times I see traders just get happy that it's in profit and then they close it out. I got $50. And I'm like, well, what was your stop? 10 ticks. So you risked $100 and got excited that you got 50? Are you insane? So, risk reward. You got to let these trade types that I'm talking about, that I have put into these videos right here, they are designed, as long as you got your north-south, they are designed to take off from that entry area. That's your pivot point, and they are designed to have enough energy in them. For example, in the NQ, I'm looking for 25 points. Unless I see something above that, and I can get more points because the red line is north of me, and I'm doing an overnight open rejection, and I'll try to get it to that. Okay, but you've got to let the trades make you the money. Otherwise, you're just fooling yourself. Because, again, I sit here and, the trades that actually make me, even today, technically, I had a break even and I had a 40 ticker in gold. Okay? Well, technically, the way Ninja looks at it, that's a 50% win rate. Even though my loss was nothing, that's a 50% win rate. Okay? So if you're going to win 50% of the time, those wins have to be bigger than those losses. Otherwise, you're wasting your time. Entries. Last piece I want to talk about is entries. Just because a pattern sets up perfectly doesn't mean I enter the trade. And what do I mean by that? It goes back to this risk reward thing a little bit, okay? But all these patterns, I don't care if it's the 5-minute red line, the static lines, the 1-minute gold line, I don't care which one it is, all of them have the same concept. And that concept is this. That concept is this. That you got candles, let's say we're looking for a long. You got candles that are coming to, say, a gold line, so a 1 minute gold line. You got candles coming in a sequence to a gold line, and when this candle right here that pierces, could be just the wick, but pierces that gold line and closes, then you're looking for a long at the break of that candle. Now, if the next one comes in and does this, and it closes, done, you looked at your timer, then you drag this down to here, and now it's one tick above that. But all these entries are the same. They all have the same concept. The problem is this. Let's just say, I shouldn't have done this because we all know this, but where I'll walk away from a trade, even though it sets up right and all that kind of stuff, where I'll walk away is this. Here's your 1 minute gold line again. And let's just say this is gold. I don't know. We'll just say it's gold. And there's my candle. Okay? There's my candle. And the distance between here and here is rather significant. So I'm asking price to cycle back and blow through here enough and not be migrating back into here and risking all my money, because where my preferred place to put my stop is right there. That's my preferred place. Protect the bottom of the candle, that's my entry, and then walk my way up from there with my stops. Well, I can't comfortably do that if the distance between the bottom of this candle and the top of that candle is 20, 25 ticks. Hell, that's half my distance to my target. Okay? So, and this is a much bigger issue, by the way, in the NQ, where you can get, one of my traders that follows me and has made major amounts of money trading this strategy, and I'm talking major amounts of money. He calls it big tails. He says, and he trades the NQ, and he says, if I got big tails, I don't take it. And it's exactly that, big tails, meaning it goes from here to here, and it's big. So the difference between here and here is like, in NQ could be like 15, 20 points. And you're entering here because you're looking at the break. Okay? That'd be a problem. Now, if the next candle opens and it consolidates, especially inside this candle, and now you're not looking at 20 points, but you're looking at maybe, I don't know, maybe 8, 10. 10 is $200. 10 is 40. That's 5. Yeah, 10 is $200. So, you're risking, say, $200. That's not bad in an NQ trade, okay? But you got to watch out for entries that create long tails. You'll also get long tails sometimes on the static line, but predominantly the rejection ones, which is the one where price comes. Let's say the line's down here. Price comes from the top. It's just sitting here doing all this monkey junk around here, and then all of a sudden it shoots down in like a 2 or 3 minute segment, and then hits that line, and just like immediately rejects back, and that candle will just get longer and longer and longer. And I'll be looking at that timer trying to close, and I'll be like, come on, timer, close. And then that timer closes, and by the time it closes, I'm in NQ, for example, I'm 30 points away from that rejection line. I don't want to be 30 points away from that rejection line. That puts too much stress on that trade V-shaping another 25 points before it comes back and knocks me out. Okay? So you got to be careful. It's just because the pattern happens too. If the candles are too big, you may not want to take it because it may not meet your risk-reward tolerance for losses. The key to this is to try to put yourself in positions where a pivot's going to happen and you're not risking a lot of money in case it doesn't happen. And the second part is to hope that price starts running away enough that you can start defending yourself. I always defend myself from the bottom up. That means on a long, for example, from the bottom up. That means I'm focused on my stop loss before I'm worried about moving my target. Okay? If my target belongs, if I look at the chart and pivots and all that stuff that I'm worried about, or another 15 ticks up or something like that in gold, that's fine. I'll recognize that. But I'm focused on this down here until price gets away and I'm not losing my money anymore or losing a lot of money. I mean, I don't mind losing 30, 40, 50 bucks. I really don't mind. I don't. Because I know so well I can get that money back. Okay? But what I don't want to do is lose those $250, $300 trades because my stop on the pivot is 30 ticks away. For example, in gold. Okay? So, those are my input pieces. It again, screen time solves everything. Recognizing the different patterns that I talk about in these videos doesn't really take that long. It really doesn't. But knowing how to enter and manage the trade from the moment you get in to where your target is, that takes a little time. And it takes a lot of time in between here too. And the other thing is, if you'll notice, I kept referencing different things when I was talking about this last topic. And that's because RTY patterns are exactly the same as the NQ, as they are in gold, as they are in oil, as they are in ES. But their personalities are different. And you got to understand their personalities. It's like having 4 kids. I have 3 kids. So it's like my 3 kids. I have 3 kids, and all 3 of them have a different personality. So all 3 of them, I had to learn how to motivate them to do what it is I needed them to do well in school, to do well, to get good friends, all that kind. I had to deal with each one of them differently to get where I wanted to go. It's the same thing with the RTY, the NQ, and gold, and ES, and YM. This works on YM, CL. You have to understand, you have to get to feeling the personality of the instrument. The personality of the instrument in NQ, for example, is it is a beast. They will steal your money and then run away. When if the market makers can sense where the people got in, they'll come back, steal your money, and run away. Okay, gold, they do that also there, but it's a little more tolerable, a little easier to deal with because it moves in a little slower motion when it's doing it. And then the RTY has its own personality. Okay. So I had to learn how to manage their personality, so I knew when I was managing my stop from the bottom up, for example, on a long, from the bottom up or from the top down on a short, I had to keep myself cognizant of the personality instrument that I was trading. Each trade type has a little bit of personality. The 1 minute gold line and the static lines, they act pretty much the same. There should be a rejection, should be a solid pivot. You should be able to just manage the back of your candles all the way to your target on your stops and be okay. The 5 minute red line, it's a little different Because again, as I tried to stress in that long 5-minute red line video, you're using a 1-minute candle on a 5-minute chart. So time has got to go by before the 5-minute traders really start helping you out on that trade. So you could have to watch it meander a little. It's a little bit more difficult. Anyways, that's my input. I hope it helps. But what my talking here can't do is it cannot replace screen time. Everybody, good luck. I hope you do well. I wouldn't put all these videos together if it didn't work for me. Okay? So, it's not going to work every day. Last week I had 2 days I lost money. Of course, it was FOMC week. And so when I lost money, I lost $140 here and like $120 there. And then all of a sudden, bam, on Friday, whoo, bing, gone, $700. Okay? So anyways, everybody have a good day and good luck. Bye.